What's up everyone, it's Scotty with Money Investing. In this video, I wanted to talk a little bit about the net profit margin of S&P 500 companies as reported by FactSet today, which pretty much goes over how we are seeing the 7th consecutive quarter of net profit margin declining for the S&P 500. So hope you guys are doing great. If you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything is going to be included, as well as all the private live streams and all the member benefits, including private videos as well. So this right here was a report that pretty much was put out by FactSet, and they do a really good job in putting together the earnings update, earnings estimates. And what you'll notice is that the blended net profit margin for S&P 500 for Q1 2023 is around 11.2%, which is below the previous quarter's net profit margin, below the year ago net profit margin, and also below the 5-year average net profit margin of 11.4%. And if 11.2% is the actual net profit margin for the quarter, it will mark the 7th straight quarter in which the net profit margin of the index has declined quarter over quarter. It will also mark the lowest net profit margin reported by the index since Q4 of 2020, when it was at 10.9%. So this right here is the decline in profit margins is what we are seeing because of inflation, of course, and because of lower revenues as well, right? So margins are compressing because costs can be oftentimes fixed. If cost is fixed or variable, and if it's actually at the same level and revenues coming down, margins are compressing for these companies. So really what we're seeing is from 13 down to 11.2%. If you compare this number from about a year ago, so Q1 of 2020, we were at 12.3%. So that's a decline year over year. If you compare this to 2 years ago, Q1 of 2021, we were at 12.7%. So we're even lower from that perspective. And if you compare this from Q1 of 2019, we were at 11%. So we are very much in line with that number, with Q1 2020 obviously being really, really low because those were the early signs of a recession. Of course, the pandemic happened back in April and March of 2020 as well. Well, this net profit margin compression is obviously going to lead to earnings declining in the first quarter 23. We already learned in the fourth quarter 22 that earnings did decline, and this is what's going to kickstart, in my opinion, an earnings recession in the first quarter 23 after the earnings season is over. Now, I've also seen many people post this, chart which shows that the earnings recession already started in the second quarter 22 because earnings have been declining since. But what they don't tell you is that they are excluding for energy. As we know that energy was the biggest component of S&P 500 in terms of contribution for earnings growth in 2022. And we've talked about this on the channel plenty of times. But you can't just cherry pick the data and be like, hey, we're already in an earnings recession if you take energy out. And earnings have been going down, so it's really not going to matter to the market. You gotta take on an aggregate basis. You gotta take the entirety of the 11 sectors in the S&P 500 and then see if you're growing or declining on a year-over-year basis. And that's really what this represents. And in the fourth quarter 22, we did see S&P 500 earnings decline after accounting for all sectors. And that's what's going to be the case in the first quarter 2023 as well. And that's going to be 2 consecutive quarters for the S&P declining earnings, and that's what's going to put us into a potential earnings recession. Now, is that going to be good or bad for the market? Of course, time will tell, but that's really what the technical term should be. That's really what the actual analysis should be, as opposed to cherry picking and only looking at 10 sectors out of 11, excluding for energy, getting rid of their outsized contribution and gains, and just looking at other sectors and be like, hey, we've already been in an earnings recession for the last 6 months. So I don't think we've been. I think we are going to enter into an earnings recession after the first quarter 23 once the earnings are out, and we do see a decline on an aggregate basis for all 11 sectors as a whole. This right here is going to be sector level net profit margins, and you can see that most sectors have been coming down except for energy. Energy is still pretty elevated at 11.8% net profit margin compared to 10.4%. Comm services is lower, materials dramatically lower because commodity prices have come down pretty drastically. Healthcare lower. Industrials is another sector that is reporting slightly better net profit margins, and so is consumer discretionary. But every single sector, every other sector is reporting lower margins as compared to Q1 of 22. And this right here is going to be versus their 5-year average. And you can see their real estate reporting a little bit better margins. IT lower. We've got communication services a little bit lower. We got materials lower, healthcare lower, consumer discretionary, and consumer staples as well. So there are a few sectors reporting better than their 5-year average, and some of them reporting worse than their 5-year average. Now, this right here is from Fundstrat, from Carl. He pretty much tweeted from Fundstrat, which I'm assuming is Tom Lee. He mentioned that 82% of companies are beating, and by a margin of 7.6%. The earnings recession wallop and the bears are expecting has not materialized. First quarter 23 earnings season will ultimately enable the S&P to push to new highs for the year, and year to date up 8%, and we see the uptrend intact. So I guess, earnings recession from a technical perspective is still going to happen. How the markets react to it, again, is still in question. And we already know Tom Lee. He's almost always bullish. Whenever you ask him about stocks, he's almost always bullish. But also one of the things that I want to point out is that 82% companies beating by a margin is because of the downward revisions that we have seen in the last 6 months. There's been significant amount of downward revisions for earnings estimates. So, we talked about it in one of my previous videos when, let's say the expectations are at $1 and then they get lowered down to 50 cents, right? Let's say the EPS estimates goes from $1 to 50 cents. And now that the company reports, let's say 80 cents per share, all of a sudden they've beaten estimates, right? All of a sudden headlines are going to read this company beats expectations and reports, 80 cents or whatever. But the problem with that is that in the beginning, we are doing these downward revisions so that these companies can beat expectations, right? In other words, the expectations already are so low that these companies are able to beat their estimates. So that's also something to keep in mind. And this is according to the Fib retracement level. We are at a 50% retracement level at 41.55. So again, we've talked about the S&P 500 kind of approaching this area of resistance. So I don't see an uptrend right now yet. What we're really seeing is a lot of consolidation sideways, and we're pretty much trading in that range where every time the S&P 500 gets up to this level, we get rejected, we sold right back down. And what we're seeing is a sideways consolidation pattern. Now, this is not to say the markets can't go higher and break out to the upside and get up to 4,500. No, I'm just putting together in an objective way the reality of the situation, and that is that earnings recession from a technical standpoint, which means 2 consecutive quarters of earnings declining for all S&P 500 sectors, not data picking or cherry picking the data here, but instead all 11 sectors as a whole declining on a year-over-year basis for 2 consecutive quarters is an earnings recession. So that will play out after the first quarter 23. How the markets respond to that will depend very much on the following quarters and what happens with the economy with respect to recession as well. Because you'll often notice that an earnings recession does not necessarily lead to an economic recession, right? So, and again, I want you to understand this very well. Earnings recession does not always lead to an economic recession, but an economic recession almost always leads to an earnings recession, right? Because an economic recession is really a significant slowdown in consumer spending, unemployment rate goes up, GDP starts to slow down and pull back and start declining, and as a result, earnings also suffer. But an earnings recession does not always mean an economic recession. So that's really what we have to weigh here. If this actually leads to an economic recession, which also many people anticipate, many people predict, then yes, markets could be under a lot of trouble. We could be under a lot of shaky ground with respect to earnings. But if there's an earnings recession and we kind of go through that, there's a soft landing, there's a mild economic recession, the markets can really just trade sideways. And once the situation improves, break to the upside, get past 4,500 moving forward. This right here is from Europe Stocks 600 hitting a 14-month high, but earnings expectations are rapidly declining in the first quarter. Year-over-year growth rate falls to 2.5% in the recession range, with Q2, Q3 estimates at 5.4 and 7.4% respectively, indicating further deterioration. So that's another thing that we have to understand, is that it's not just in the US, even in Europe, you'll notice that earnings growth estimates are deteriorating significantly, not only for the first quarter, but for remainder of 2023 as inflation continues to be a problem, interest rates continue to be higher and keep rising, and not to mention that unemployment is also becoming a bigger problem as we see all these layoffs. So let me know your thoughts down in the comment section below. Again, my playbook is very simple. I'm trading mostly in this environment, and if prices do come down to my fair values, I'm happy to dollar cost average, happy to buy. But then also, if you do see these rallies, I'm not going to shy away from trimming, raising my cash exposure, taking some profits off the table, and selling into these rallies, considering that there's still a lot of uncertainty. Once the data comes out, once a lot of these reports come out, once there's a lot of certainty in the market, I'm happy to continue to add to my position as the market's rallying. But right now, considering volatility, considering the bond market, considering interest rates, and of course the market with a resistance, that technically speaking, I'm not super comfortable taking long trades from a risk reward standpoint. There's not a lot of upside with respect to the downside that we have. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below if you're interested in joining. As always, happy investing. And there is a 16% annual discount available till the end of this month. As always, happy investing. I'll see you all in the next video.